here we're looking at the difference between futures and forwards. Okay. We spoke about exchange traded and over the counter. That's the biggest difference. All right, so you've got a summary here for the two, futures and forwards. Okay. When you look at the future, okay, versus the forward, the future is regulated and there's an additional level of, let's say, peace of mind. Okay. And remember, when investing, your biggest risk is what? Not being able to receive your profit. Okay, so you make a nice profit, but you just can't get it. Okay, that's a problem. Right, so when looking at futures, futures offer that level of security because someone is going to meet that, let's say, obligation to pay in case someone is in a bad position or someone is in a good position. So the good position person should receive the profit. The person in the bad position should be the one paying the profit. Okay, and they often talk about marked to market. Okay, and that's not currency, CFDs. Okay, so contracts, okay, derivatives are generally marked to market. Futures are marked to market. And what does that mean? It takes the person that's out of a profit and it compensates the person that's in profit. Right, and that happens day to day, so it creates liquidity in the market. So you never have a situation where someone has a big profit, okay, and someone is in a massive loss, so minus and plus. Okay, remember, if that person's up, that person's down for a future or a forward. Okay, so that's a contract in terms of a CFD. Okay, so when looking at contracts for difference, they go through product providers or brokers. Okay, and if you are, so we spoke about demo accounts and online trading, that, so if you're considering brokers, you do need to look for brokers that have STP, which is straight through processing, because there's no interference in terms of pricing. Okay, because some brokers do things a little bit, what do I want to say? Let's say dodgy. Okay. All right, so you don't want brokers that do things dodgy, okay? You want brokers that are regulated. So if you're looking at CFD, you want, if it's the UK, FCA approved, okay? There's obviously regulation. And then in the US, there's also regulation there in terms of either security exchange, okay, or other. Right, but you need to look for regulation, right, in terms of brokers, right? And if it's STP, it's straight through. That means the broker's not filling your order, okay? It's the bank that's filling the order, right? Because banks shouldn't go bankrupt, right? Because the broker acts as the intermediary for the intermediary, if that makes sense. So you're looking at the broker in terms of information. So you're using the broker to access products from a big commercial bank. And that's STP, right? And that's marked to market. So when you go through a broker, they mark to market your position. So every day you pay a certain fee or charge for your open positions, because those positions are either in the money or out the money, depending on your situation. Okay, and what does that do? That creates liquidity. Okay, so when looking at futures, the key word here is a clearinghouse. All right, so the JSE offers futures because the JSE is the clearinghouse. Right, the JSE will take from the one party and pay to the other party because the contract is between those two individuals. It's almost like someone controlling that transaction, if you will. Okay, it's like when think about playing Monopoly. Okay, maybe you played Monopoly when you were younger, and you always have someone who's the banker. Okay, you don't have a player who's also the bank. Okay, so you might have been both. Right, if you were both, it was probably because there wasn't anyone else that was willing to be that. But generally, you'd want a separate party, okay, to manage the bank. Okay, in terms of that transaction. So the JSE offers that in terms of a clearinghouse. The JSE. Okay, the JSE is the clearinghouse that adds liquidity and peace of mind to those contracts that are promises to pay between two parties. One is the buyer, one is the seller. Okay, and all those contracts are standardized. Right, so there's a standard quantity in terms of quality. Right, so you don't have any contract on the JSE. Only contracts meeting certain requirements will be allowed to be listed on the JSE. Okay, it's like equity. You can't sell any share on the JSE. It must meet certain requirements. Same thing for contracts, and there's certain rules that need to be followed. Okay, and dates. And they always talk about like futures close. You might hear that quite often in the media. Okay, you normally hear those investment analysts, they talk about, oh, the market went up, why? Futures close. Okay, it's because people are closing their positions. Okay, either positions that are in profit or positions that are not in profit. So it can either increase or decrease the market. Sometimes there's a slight drop in the market because of positions being closed. It all depends. Okay, but futures close is also quite a important, let's say, not really news item, but more time that there is added volatility. Okay, and you don't obviously want volatility when you're in a particular position where you want it to either rise or fall. Okay, volatility is good because that gives you the opportunity to get in. But once you're in that position, okay, you don't want things like the futures close to wipe out some of your profit. Okay, you want to keep things as consistent as possible while being in the position. Okay, so volatility is good for getting in to certain positions. So as you said, the Brexit was bad in terms of a drop. Okay, and then obviously there's a massive decline in terms of this huge negative spike in terms of where price was to where price went to, and for a few days it continued to go short. Right, but now things have reversed. It's come back, right, and that's because of consensus, okay, in the market, and how certain people change their view, right? And normally things like that happen around futures close, okay, because big institutions close their positions. All right. Forwards are over the counter. What does that mean? Correct. There's no peace of mind because no one is standing, okay, as safeguard between the buyer and the seller. Okay, it's direct. Okay, so that's a forward. And they're custom made as well. All right, so even though there's no intermediary or clearinghouse, okay, there's still a market for those instruments because everyone wants an opportunity. Okay, and we mentioned that earlier. And performance, okay, is promised. It's not guaranteed. There's no guarantee with the forward, and so it's riskier as well. And because it's riskier, it might be a cheaper option than a future, perhaps. Okay, not always, but perhaps. Futures might actually be cheaper because they're widely traded, so there's a bigger market. Okay, forwards aren't as popular, so less demand. Okay, maybe a specific supply, and that obviously changes the price. Okay, there's definitely a default risk, and what does default mean? Correct. Okay, no one meeting their obligation. Okay, so someone not doing what they were supposed to. Okay, and then not marked to market, i.e., there's no paying over of funds from one individual to another. Okay. All right. So, what is your view on derivatives? We've looked at it today. Okay, you've got a pretty good view now of the scope. So, what we're going to look at? Obviously, we're going to look at the numbers. How do we calculate certain things, etc., as we go through the course. But for now, what's your view?
I like derivatives.
Okay. Why do you like derivatives?
Opportunity. Because it's...
So what opportunities do derivatives present?
Well, they give you the opportunities you're not going to go and get in equities and bonds, where you can go another way. I don't even know how to explain it.
Hedging?
Yeah, hedging.
Maybe.
But it's also, I think also what I like about derivatives personally is people always say they're very complex, and I think they are, but I think you need to understand them.
Yeah.
That's my personal draw to them.
Correct.
It's just people mistake them for being very risky because they're complex.
Yeah, and that's a good point you raise. So people are afraid of things that they don't know.
Yes.
Okay, so I mean, even when I first started in terms of like markets and so on, it's a bit intimidating at first, but you always have that passion, and that's what drives you towards that. And then you get the education, and then you think, well, it wasn't so bad,
Yeah.
and then it gets better because it's that fear initially, right? So I agree. Derivatives are complex, but they're complex in a sense in terms of calculation and also maybe understanding. But if you understand those derivatives, they're actually very powerful. And that's why you've mentioned they're good. You've got a good positive view on them. Okay. What about this? What did Buffett say? Okay, this is a quote from Warren Buffett. Financial weapons of mass destruction that could harm the entire financial system. What do you think he was defining? Yes. Okay, so this definition was Buffett's view on derivatives. Okay, and we know Warren Buffett is a master of long-term value investing. Okay, he is like the celebrity, the key in terms of long-term value investing. Right, so Buffett views derivatives as being weapons of mass destruction. Why do you think he says that?
When did he say it?
I don't know when. Yeah, I don't know when. Okay, in terms of when he actually quoted this, but this is his quote. Okay, Buffett has been quoted saying financial weapons of mass destruction that could harm the entire financial system.
Well, I mean, I know firstly they are regulated, but they're not as regulated.
Good. Okay.
Dark markets.
Oh, okay, yeah. You're looking at those like fourth markets, fifth markets. Yes, yeah. Okay, correct. So that's definitely something to consider. So in terms of regulation, definitely. And what else?
Also, they have a very big say on our financial systems and our equities, our bonds, our stable. They are.
Okay, yeah. So we'll discuss how big the actual markets are.
Yeah, they drive those markets.
Okay, and what else?
And when they crash, then you get the global financial crisis.
Okay, and do you agree? What did we say a derivative is? It's just a contract. It's a piece of paper for something
underneath it.
Underlying. So do those pieces of paper actually have any value? No. Okay, so for Buffett, all right, he would probably consider buying the actual asset rather than buying the derivative.
But he can afford that.
Okay, sure, yeah, definitely. But I'm just trying to deconstruct his quote in terms of why we think he believes derivatives are weapons of mass destruction.
So he doesn't trade in derivatives at all.
Okay, he does have reinsurance. Reinsurance could be a form of derivative. Okay, so it's just a quote that he's mentioned in the past relating to derivatives. Okay, not to say he probably has considered options and maybe forward and futures and those types of things. Okay, I don't know enough about his portfolio, okay, in terms of his company, but what I do know in terms of the theory is that derivatives don't have any value. They derive value based on the underlying. Right, so for a derivative, okay, in terms of, so let's say we had sufficient capital, okay, would we choose to invest in those shares rather than speculate? Probably. Okay, if you really want to buy equity, you would just buy equity. Okay, but if there was a chance, you could maybe speculate, okay, but also with speculation comes risk. Okay, so as much as you're speculating, it can or can't happen. Alright, so the thing is, if you're happy to hold those assets for a long term, just buy those assets. It doesn't matter what happens. Right, so for example, what we know about Buffett is a long-term value investor. Right, so for him, derivatives are more short-term. Okay, they're more, let's say, contracts with a specific period or time frame. Okay, Buffett's philosophy in terms of, if you read The Intelligent Investor, okay, Benjamin Graham's book, okay, in terms of value investing, that's exactly what Buffett does. Okay, Buffett is there to invest in shares that are undervalued, and he's happy to hold them for 20 years, 30 years, forever, basically, because his company will last forever. Okay, obviously he's the genius, he's the guru, okay, but his company, Berkshire Hathaway, will last or survive long after, okay, Buffett obviously passes when he does, okay. Alright, so some statistics. Okay, this might be a little bit outdated. Okay, I don't have recent figures. Okay, I'll have to do some research to find them. But for now, let's just use these numbers. Okay, OTC derivative contracts. 2010 was shortly after the crisis. Okay, we had the crisis 2008, very bad had 2008 here, then 2009 sort of like a spillover, and then things kind of got going 2010 onwards. Okay, so having said that, how big do you think the derivative contract market was in 2010? OTC. OTC is over the counter. We're contrasting. Over the counter exchange traded.
I actually think OTC. Are we talking value?
Yes.
Not volume, okay.
Yeah, value. So how much in terms of rands?
I would say OTC is bigger than exchange traded, to be honest.
Okay, so let's put in an amount.
I think billions too high.
Billions too high. Okay, so go with a number.
50 million.
50 million for which?
For OTC.
Okay, and exchange traded?
I would say 30 million.
30
I
million.
think it's smaller.
Okay, so 30 million for exchange traded, OTC
50
50.
million.
Okay.
I'm shocked, probably. Oh my word.
Alright. In terms of US dollars, 601.1 trillion. Okay.
OTC.
And this was after we just had a crisis.
Exactly, and they were blamed for this crisis.
Okay. So in terms of rands or dollars, okay, this was obviously dollars, it's a lot bigger than rands. Okay, so a billion rand wouldn't come close to this. Okay, but it's a big number. Okay, a trillion is how many zeros?
8 zeros.
No.
90.
Okay, so let's write this figure out.
That's a lot.
6011. Okay. Now we need to add zeros. So that's where the trillion is. So a million is 6. 9 zeros is a billion. 12 zeros is a million. So we need to add, well, there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 US dollars. Okay. And that's how big the OTC derivative contract market was in 2010. And that's after a financial crisis. Okay.
Let's see what it was.
You were right in terms of OTC being higher than exchange traded. Okay. Why do you think it's higher?
Customization.
Correct. Okay. People want freedom to create contracts. People don't want to say, well, I want a contract, but it must be this. Okay, generally, okay, people aren't, rules generally, how can I say, limit, okay, creativity. Okay, so if you don't have rules in place, you have more room for creativity. And that's why OTC derivative contracts, they're creative. Because what did we say? You can do anything. It's custom. You can make a derivative for anything you like. But obviously exchange traded, certain derivatives won't be traded on an exchange because it won't meet the requirements. But OTC, well, anything goes in the OTC market. And that creates a very, very big risk. Have a look. It's almost 10 times the size of an exchange traded derivatives market. That's massive. Yeah. Yeah, derivatives are actually, as far as I know, no, I think Forex is probably bigger, but derivatives are probably close. Okay. Alright, so, do you recall the 2007-2008 crisis? Yes. Okay, so now we can talk more about the swaps. Okay, so we've spoken briefly about this in other modules, but now we can talk about this. What is this? This is a derivative. Okay, so what caused the crisis?
Lumping up mortgages.
Bad products, yeah. Lumping up mortgages as what?
Special purpose vehicles and selling mortgages good quality.
Yes, okay, so it's a liability that's financing a liability. And then that liability financing another liability. Yes, good. And then the cards crumble, okay, when the one liability defaults. Okay, then the house of cards come tumbling down. Okay.
Whoever holds the bomb at the end, shameful there.
Yes, and that was Lehman Brothers basically, yeah. Right, they literally, like, they made Lehman Brothers the
scapegoats.
Yes, exactly, good. Okay, and then this. Have you seen the film yet?
Yes, it's brilliant.
Okay, good.
It was absolutely fantastic.
Alright. Okay, if you didn't, I was going to play the trailer for you. Okay, to try get you to watch the film, because the film is, yes, it is a very good film in terms of it's entertaining. It's a true story. Big Hollywood actors as well, and it's recent. Okay, in SA January 2016. Right.
We were wondering. We actually, a couple of us at work that actually watched it.
Okay, nice.
And we were thinking to ourselves, we wonder how much is true and how much we started to read up, and they're pretty factual actually.
Yeah, the book is probably more accurate. I haven't read that book. I'm not a fan of fiction. I'd rather watch the movie. I'd rather read a textbook, to be honest, than a story. So I'd prefer, like, entertainment is great. So like watching a film is great.
Yeah,
okay.
exactly. And when we started to read, they weren't far off actually.
So you've read the book as well?
I haven't read the book. I just read just a little bit on the internet and just try to find a couple of factual, and
not all of those characters were accurate. They were based on people in real life. So the only name that was accurate was Mike Burry. Okay, the other characters were how can I say, portrayed on other individuals. Yes.
They weren't, the characters were not, but the storyline itself.
The storyline was true. Yeah. What happened was accurate. Yeah.
And the broker, the guy that acts as broker.
Yeah, this guy.
Yes.
Gosling's character.
That's it.
Yeah. This guy's the broker. Yeah, for I think it was Citibank or something he worked for.
Yes.
City or was it? I don't know. It was a big bank, US bank.
Yes, and they were accurate.
He was the broker. Yeah.
It was just very interesting.
Yeah, and then this guy, he was like an ex Goldman trader or something. Yeah.
Correct, yes, and he was real as well.
Yeah.
And he was crazy as well.
Yeah, and then
He was that man.
Yeah, Carell's character. He was more like, he was almost like the conscience of the story. Because he had like a moral, because the thing is, he was in banking and then he left, and then he was like he was fighting for the rights of consumers. He was like an activist.
Exactly. He was the masses.
Yeah.
Almost. That's what it reminded me.
Yeah, and then you had obviously Bale's character, and he was the actual the foresight. He saw the problem. Yeah. Okay, but very eccentric character, and but also very intelligent and strange as well. Okay, but yeah.
It was fantastic. It was a very good.
Yeah, I want to buy. It's one for the collection. So I want to.
Exactly.
Yeah.
Like, I didn't enjoy The Wolf of Wall Street.
Yeah.
I read the book, but the movie I didn't enjoy.
Yeah, it was more Hollywood, what's like sex sells. So that's sort of the take that they took.
That's it.
Yeah.
It was like with this movie, it was like I know, because Tony and I watched it together, and I had to sit in this movie. I actually had to sit and explain a couple of things to him.
Yeah, because this show was actually educational as well.
Yes.
Because they broke down some of the concepts simply, and that it helped the audience as well. So anyone could have watched this, even someone without a commerce background probably could get what was going on.
There was some of the technique. I know it's only to be some of the terms are a bit foreign.
Sure, yeah.
No, so it's fine. 2 seconds to explain it and you've got it.
Nice.
So you can be into it.
Okay, good. Okay, great. And then a note here about transparency and regulatory oversight. Okay, so what should we be looking at? Is transparency a good thing?
Yes and no.
Okay, when you say yes, why do you say yes?
Because transparency allows you to have regulation, if that makes sense. So if a transparent market, you're not going to have, then you're going to lose your profits, and you're going to lose your. You want it to be transparent. You want to above board, etc. But then you lose the customization. You lose the.
Yes.
You lose the profit. You lose the arbitrage. As much as people say there isn't, it does exist.
Okay. So, do you agree? If everything is transparent, okay, will certain companies have a competitive advantage? No, because there are certain trade secrets. Okay, so you can be transparent to some extent, but at some point in time, companies need to be protective over their their goodwill. Okay, that intellectual capital and so on. All right, so when looking at transparency, as much as we want banks to be transparent, can they?
Between you and them, yes, but I think between what they do and behind the scenes.
Okay, so who do banks have to be transparent with?
Their customers. With their customers' money, essentially. If that makes sense. If I give the bank 100 Rand and I tell him to put it in a fixed deposit,
yes.
I know he's going to take it and
okay.
do something else with it. But I don't expect my 100 Rand at the end of that.
Yeah, okay, that's more responsibility in terms of they're responsible to return the capital,
but
sure.
They do not have to disclose to me what they do with my 100 Rand for the next 6 years or however long I invest it.
Okay, yes, correct. So there's no transparency there, or not as much transparency. So where do you have transparency? Who do banks have to be transparent with?
Well, I have to be transparent with the interbank department.
Yes, okay, Reserve Bank, i.e. regulators.
Yeah.
Okay, so transparency, you can't get away from government in terms of regulation. Right, so for banks, transparency is key for the regulators. Right, and that's why when you have an exchange, even those exchanges are regulated. So transparency should be present between the regulator and the bank. Okay. For the client, there isn't as much transparency because the client is external to that regulation, right, between government and the banks. Okay, so if we didn't have good policies in place, so if we didn't have FICA, if we didn't have FAIS, if we didn't have POCA and all those acts that protect the industry, okay, the industry could be very different, right? And we've seen that in The Big Short, right? The industry is run or is motivated by greed, unfortunately. Okay, but greed shouldn't be why we do things, right? It should be because of the value that you're creating, right? So if banks act in terms of their value, what is their value? Their value is to provide a service to facilitate transactions in the economy. Okay, it shouldn't be about making as much profit as possible, right? And when that changes, so in the past, banks should be focused on values, creating a product in terms of a service, being an intermediary. Okay, in terms of making a profit, that shouldn't be the focus, and that was the focus in 2008, which was a problem. Okay, so derivatives can be privately negotiated. Does that provide transparency? No. Okay, if it's traded on exchange, that does provide transparency. So if we're looking at transparency and regulatory oversight, those are some of the examples that you would look at in terms of access, okay, to these products that are regulated, that are quality. Okay, so the example I'm going to make is you don't buy groceries from anywhere. Okay, you buy groceries from a retailer that you trust. Okay, you're not going to buy groceries from anyone, all right, because you don't trust the quality of those goods. And that's what we're looking at here. So the JSE has the SAFEX. Okay, SAFEX is the equity derivatives market. Okay, you obviously get other markets in terms of bonds. Okay, you get bonds in terms of bond market and so on. If we're just looking at derivatives in terms of equity, that would be the futures. Okay, here's the London, okay, International Financial Futures Exchange, and then you've got the CME, okay, which is the Chicago Board of Trade. Okay, and those are some of the names that they've actually spoken about in the textbook. Okay, because it's an international textbook, it's a CFA prescribed textbook, so the focus is going to be more from a US point of view because the CFA is a US qualification. All right, so the type of questions that you'll see, or not questions, the type of examples you'll see in the textbook are very much focused on America. Okay, and you would have seen the same thing in the bond textbook and the same thing in equity. Okay, don't worry too much about that. Just focus more on the SAFECA and focus more on the calculations and the theory. Okay, because the theory is universal and the calculations are universal. Whether it's JSE, SAFEX, or whether it's US CME group, it's not going to make a difference. It's just a different market. That's it. Okay.